So, look, do I think that we're going to see rate drop? No. Continue getting higher and higher. And I think a large part of this is just that, we are in a healthy economy. People are still busy. There's a lot of really good things going on. And, what we're seeing now, this first drop is largely due to the people that are being frivolous. We've seen people out there binging on 0%, this 0% rate, where interest rates have been about 2%. Buying the expensive houses, buying the expensive cars, spending too much money on frivolous activity, using this economic cycle to spend as much money as they can. Whereas there are parts of the market, actually the vast majority of the market, where they are actually holding off. They're not spending as much money as people are out there. So what you're seeing is all the frivolous money is dropping the most. Property prices at the top end are actually coming off. It's softened quite a lot. But the middle part of the market and the lower part of the market, they're most resilient. The lower part of the market hasn't really moved that much at all. Now, if you have a look at what the bank's recent data is, the average homeowner has about a year's worth of savings in their bank account. When I say a year, that's about a year's worth of interest repayments to cover their debt. Now, if the whole of the vast majority of the market, that's on average, it's got about a year's worth, that's telling me that they're not very frivolous. They've got savings, that if interest rates continue to rise, that there's still a lot of debt still there. Peter's just joined us. Hey, Pete, this is impromptu. I saw that you joined and I thought I'd invite you. Peter is Wealthi's philosopher, shall we say, and the man that reads more books than most, follows the economy very, very frequently. You'll see him on BBC, ABC. He's on a lot of the major news networks. He's normally suited up. Today, I've caught him off guard. Peter is just dropped off. There you are. Pete, thanks for joining.
Thanks for having me, Dom. Great to be with you and your audience.
Mate, thank you. You and I will talk about this quite a lot. And I guess the question that I'm talking about in the live today, is the property market going to crash? Are we going to see 25% price decreases? I've been saying no. I don't think we're going to see huge crash that people are expecting or that economists are expecting. What do you think? What are some of your thoughts?
Look, I think there's a couple of ways to answer that question. So in terms of picking the market short term, it's always hard. I think if you had asked me 2 years ago, will the market go up 40%? I would have said no. And if you ask me today, will the market go down 25%? I'll say no. Because, short-term market movements are driven by sentiment, they're driven by global events, they're driven by pandemics, and all these things that we can't really control. But Dom, if you say to me, where do you think property prices will be in 5, 10, or 20 years? I've got a lot more certainty and I've got a lot more confidence because I know that the price of everything's going up. The replacement cost of real estate, real estate's different to a stock or a crypto. They're digital assets and they're really assets based on the cash flow, the future cash flow or the value of something or the perception. Whereas real estate is an actual thing. You're standing in a building, those aluminium frames behind you have a certain cost. That window, that seal, every single thing has a cost, right? And the cost of all these things that make real estate are going up. And they're going up by a large factor. So in 5 or 10 years, do I think it's going to be more expensive or cheaper to build a house or a building like the one you're in? I think it's going to be a lot more expensive. And for that reason, I think real estate's going to continue to perform well as an investment over the medium term, but it's going to have some short-term fluctuations, and that means different things to different people.
I completely agree with you. I'm on a construction site right now, and I can say with all assurity, and I'm doing some renovations. You and I work with builders every day. Construction costs are not going down. So the replacement value of the asset, of property, is going up. We might see it soften a little bit as more migrants come into Australia, but that's just the labor costs. Material costs are still very strong. Labor costs are still quite high. And, as you're saying, it costs so much for you to replace what's currently there. So there is a minimum really that properties can sell for without it being unfeasible. Now the cost of buying real estate is getting more expensive because of the interest rates. And you and I talk about this quite a lot, the fact that basically we're coming out of a not normal environment. We're coming out of very, very low rates into maybe more normal, more cyclically normal interest rate environment. And it feels a little absurd for the property market to drop 25% as a result of that. I don't see it, maybe parts of the market. But what do you think about interest rates and the fact that they're moving to a more normal rate? And where do you see them sort of stopping up or slowing down?
I think it's the best analogy I can paint is like a patient who's gone to hospital and been fed morphine. The global economy was like a sick patient, went to hospital and it got drugged up. And, when you get drugged up at hospital on morphine, you start to hallucinate, and the world is very different to when you wake up, get taken off those drugs, have to go to rehabilitation, whether it's your body that's injured or your limbs that have been hurt, and now there's a little bit of pain to go back to normal. And that's what's happening. We're going back to normal. We're going back to an environment where, for a country like Australia, it doesn't make sense for the cash rate to be 0.1%. Yeah, that's just crazy. So we're going back to cash rates that we've experienced before. If you have a look at since the 70s, where interest rates have generally averaged, it's been around 3 or 4%. Which is in line with where everything else in our economy works out. It's going to be a bit of a breaking period. Some things are going to break, some things are going to be fixed, but we're going back to normal, Dom, just like every other facet of our life.
Yeah, and I'm glad you said that. I've just got this little poll live for anyone that wants to agree or disagree. But I actually think that interest rates going up is a good thing. It's as you said, we're getting off the IV, and for anyone in there that thinks it's a good thing or a bad thing, put your poll in there. But I think that, I think interest rates going up is actually a good thing. It's stabilizing things. It's taking a lot of the frivolous spending out of the economy. It's causing people to be a bit more sensible with the decisions that they're making. The buyers that were in the market, or the sellers that were in the market for the past 6 months, were people that were just looking to get crazy prices because people were there to pay the crazy prices because it was 2% interest rates. Now that things are becoming more normal, it is coming back to a more normalized environment. People that are selling have to sell, not because they want to sell. And it's actually now becoming a bit more of a normal environment where it's a bit more opportunistic as well. So I've got a
Yeah,
question here.
yeah, go for it.
This guy's saying 70% of wealth is owned by a handful of people. Inflation makes wealthy more wealthy. This is no accident. It's engineered. Um, okay.
Inflation does make
Well,
yeah, it does. It is right. Inflation does make the wealthy more wealthy because assets inflate more than paper money. Paper money or savings in the bank, they're printing more of that. But it costs more and more to create a house or to create rare assets. So yeah, you're right. I don't know about the 70% is owned by a handful. Depends what you define as a handful. But there is, the wealthy, those that accumulate assets have figured out that you get ahead by buying assets.
which is a really good point. We won't sit and harp on it. I think for all the people that are out there that they're fearful, they're scared, they're not sure what to do. You know, you and I are going to sound biased, but what we're going to say is get into the market. In spite of all the fear and uncertainty, in spite of the fact that interest rates are going up, to Zooks, who said that, inflation makes people more wealthy, you can choose to either part of the people that are riding or using inflation to their advantage, or you can have all your money in cash and really come, and the value of your cash is going down. Pete, is there anything else you want to say to wrap up today's live?
Not really. I think the building you're in looks pretty cool. Looks pretty interesting.
Yeah.
But other than that, I think we've said what are the most important things, which is think about the long term, think about the value of the paper money that you're holding, and just have a look around and ask yourself, are things getting more expensive or less expensive? What does that mean for assets like real estate in the long term?
Yeah, that's exactly right, Peter. Thank you very much. Thanks, Zooks, for putting your questions in there. For all the people that jumped in on that poll, it looks like the vast majority of you think that it is actually a good thing that rates are going up. We appreciate your time. If you've got no more questions, we'll kick on with the day. Have Friday. Peter, I'll catch you later, and we'll see you all later. Have a good weekend.